This is apropos. The White House has hit back at suspicions of insider trading after an unusual spike in oil futures. Some analysts are pointing to activity on Monday when an abrupt burst of oil futures trading hit the markets about 15 minutes before President Trump announced he was delaying threatened strikes on Iranian energy targets. It's raising questions on if anyone acted on insider knowledge. Allegations the White House says are baseless and irresponsible. Donald D'Souza reports.
It's an anomaly which stood out on global trading floors at the start of the week.
Someone sold oil at an excellent price a few minutes before the price dropped over 10%. So it's a great trade.
A transaction placed Monday when the energy markets were stable, 15 minutes before a Truth Social post from Donald Trump. It resulted in the price of oil plunging 14%, a windfall for whoever hedged their bets.
It raises some questions. Either someone has a great instinct and a lot of luck, which can happen, or it was someone who was tipped off. There aren't other possibilities.
Traders reportedly made bets worth around $500 million in the oil market before Trump's post. And for now, it's unclear if one or several entities were behind Monday's trades.
Perhaps some of these actions occurred from participants in the Middle East rather than within the administration. So I want to be super cautious about pointing fingers at anyone on that front, but it was highly suspicious.
While the White House says the administration doesn't tolerate any official illegally profiteering off of insider trading, some Democrats are raising alarm bells, calling the moves mind-blowing corruption. For now, there isn't any proof of market manipulation, but Monday's well-timed trades are similar to profitable bets made on prediction site Polymarket, which allows clients to place wagers on real-world events. Certain users anticipated the capture of Venezuela's President Nicolas Maduro or the killing of Iran's supreme leader, with some accounts created a few minutes before the incident unfolded. Hedging bets on Trump's decisions has now become profitable business for some.
Well, to help unpack all of this further with us, let's bring in Meziane Lasfer, who is a professor of finance at the City University in London. Meziane, thank you so much for being with us on the programme. First of all, what do you make of all of this? Is this just a lucky coincidence, or are we looking at evidence of insider trading?
Thank you for inviting me. So I think it is a really kind of critical question here as to whether it is insider trading or not, because on the one hand, we could see that it fits in within the definition of insider trading, but on the other hand, it complicates the issue. It fits in with what we mean by insider trading. It's really trading on insider information that the market doesn't have. So you have private information that we trade on, but the market doesn't have it. So it's like really cheating the market effectively. But the problem is really kind of defining what is this information and whether really kind of those traders really got the information. So from a legal so first of all, I'm not legal, I'm not lawyer, so I'm professor of finance. I do research on insider trading. However, in order to do that research, I need to know a little bit the law. So that's really what I'm going to explain here. So from a perspective of insider trading, really kind of the SEC in 1934 clearly defined insider trading that it is when you breach the duty of trust or confidence. You trade, the trades are based on material and non-public information, and the trader knew the information was not public. That is, therefore, it is a breach of duty. What we need to focus on here is on those two main factors, which is materiality and non-public. So materiality, as you rightly showed in your report, it's really quite huge because they traded $500 million, and then the price on the Texas, in the West Texas Intermediate, declined by about 14%, as you mentioned. So the gain is really going to be quite substantial. So, but however, what is interesting there is that if you look at that graph, I don't know whether the audience had noticed or not, is that there was really no change when the trade occurred. So the change occurred only when the information is released. So when Trump said, put that information. So in other words, the other traders in the market really didn't know about it, because otherwise we would have seen a really very big drop in the price of oil when this trade has occurred. But it's really it's after 15 minutes later that we have this drop in the oil price. That really that there is a manifestation there of the reaction towards the oil price. So from that perspective, we can really define it that it is from a materiality perspective. It is clear that it is insider trading. However, there is this non-public element that causes some issues there. So in other words, that we need to find out that really those traders traded on information that is not publicly available. That is really the other market didn't know. So it could be that the traders just use some algorithm models. It could be that there was trading or technical trading, in which case then it is illegally trading, because they're just exploiting their knowledge, exploiting really their expertise in trading in the market, and then they get it right. So maybe other days they got it wrong. Maybe they traded a lot, but really nothing happened. The second one is that so in this case, then it is legal trading. We cannot say that it is not illegal. But on the other hand, if the trader really knew exactly what the news is going to come up, and they traded 15 minutes before, taking advantage of their information, then we can consider this as being non-public and therefore an insider trading on insider information.
Meziane, thank you so much for that breakdown. Let's move on, because we are running out of time. If what we are suspecting is true here, that we are seeing evidence of insider trading, how can regulators realistically police platforms like Polymarket, as we mentioned in that report, where it's so hard to trace the identities of those making the bets?
It is very difficult for the market really for the regulator really to find out. So in other words, there will be really lots of investigation by the SEC, and therefore they will really look at those two elements that I mentioned there, the materiality effect and the non-public information factor. So they will investigate, for example, whether this trade is just one-off. So really that trader or those traders didn't trade before, so they wouldn't say that it is just if they were trading all the time. That from my research that I have done, then when you see that the traders are very expert, in other words, they trade quite a lot, then it is very difficult for the regulator to find out that they are trading specifically on that information, because they're just normal traders. But it is just one-off, then that is really case for the regulator to consider. So they need to consider also whether there is any linkage of information. So whether there is a transmission of information from the from really the government into those traders. There is also the fact that in general it's quite costly really to go after those traders, because it takes time, and also it's very difficult to investigate. So really the regulator is going to be in a very difficult position of really proving that the trader knew that this information is going to be released, and that they traded really on their own conscience to take advantage of that information. So overall, really, the regulator is going to have some difficulties in finding out. However, we've got the regulation there, even because it is in the oil rather than in shares where I do my research. So even in the commodities, there is strict regulation that whoever trades on inside information will be prosecuted. And we had a number of cases where those typical traders have were prosecuted.
Well, the big question is whether, there was a leak here, whether information like this is falling into the hands of people who make bets like on platforms like Polymarket. Should we see this also as a threat to national security, where perhaps information like this is being circulated in these kind of circles so freely?
That's really kind of another critical issue here, comparing to the research I do. Well, my research is mainly on the companies, on the insider trading by the directors of companies. So it's kind of, and they trade on different information like earnings announcements, mergers and acquisitions, kind of the profit warnings, etc., where the information is only kind of limited to the company. But here, the case is really kind of, is much, much more complicated because, as you rightly said, it is security information. So if they find out that really some people have got that security information well before it is disclosed, then there is some failure in the communication of the government. So it makes it really very, very complicated. Yeah.
And we've also seen throughout President Donald Trump's presidency, we've seen his family members profiting from the political context we find ourselves in. Eric and Donald Trump Jr. have invested in drone companies that have been competing for Pentagon contracts. We've also had Jared Kushner, Donald Trump's son-in-law, seeking to raise billions for his private equity fund from Gulf countries currently entangled in the war that we are seeing right now. Should there be more stricter regulations to prevent Donald Trump's family from financially benefiting from political activities or from, the context that we find ourselves in now from war?
I think so, to a large extent. What you said is right. But however, there is a kind of another complexity here, is that it's really political. So there will be the legislator that is involved there, but also the politicians that are going to be involved. So I would guess that, for example, if it was in the UK, we have a specific regulator for the politicians. We have, for example, the National Audit Office that is really kind of controlling all the activities of the politicians. So it makes it a little bit much more kind of, you have the FCA that is going to get involved, the Financial Conduct Authority that is going to get involved from regulation of the market, but you have also the National Audit Office that is going to investigate to see really whether those transactions really occurred from a political perspective. I would guess that in the US it's the same. They have the SEC that is going to investigate from this insider trading regulation to apply the regulation, but also there may be a kind of the Senate maybe that is normally going to investigate whether it is driven by political connections or something like that, which I cannot really comment on that side because it's not my area. But I would think that really from the Securities and Exchange Commission kind of side, there will be really kind of looking at this very, very kind of thoroughly to check whether it is done, first of all, whether it is an insider trading and with trading who has got this private information. And then it might probably go into the politicians to deal with the case.
Meziane, thank you so much for your insight on this. A really thorough explanation from you. Thank you for joining us on the program.
Thank you very much for inviting me.